Friday, 7th of July, and first trading Friday of the month, so, well indeed, first Friday of the month, so non-farm payrolls day, so we'll talk about the US labour market during this briefing and kind of just get our heads in gear as to whether this information carries any significance with regards to the Federal Reserve and their pathway for rate hikes, or indeed the Federal Reserve and their pathway to start reducing the money supply. We'll also talk about what it means economically and look at some of the employment related data we've already had this week and try and figure out what kind of figure we might expect. That'll be announced at 1:30 today, so that'll be the kind of big data point. But before we talk about that, let's kind of catch up on stuff that's been happening yesterday and overnight. And I definitely need to start with a bond chart. So this is the Bund. Let me just move some of these lines here. This is the Bund, and this is the German 10-year government bond futures. And what I'm looking at here is this kind of sharp sell-off we had yesterday morning. So it kind of got going just after 10 o'clock, and we really rifled lower in it, and it began a very persistent downtrend throughout the whole morning, flattened off a bit in the afternoon, but obviously, as you can see, finished right down on the lows. And this morning, if I just draw a line in there, that was the low point yesterday afternoon just before Europe finished. And then this morning we tested it at the open here, and now we've broken it, but it's a bit messy here. We've just gone back above it, but the main story is this is a continuation of the big story of the last 2 weeks has been bond markets and bond prices, not far off. You could, well, I was going to use the word collapsing, which perhaps is a little bit strong, but it's definitely the biggest sell-off we've had in bonds for quite some time. And to get this into perspective, I'm going to go to a weekly chart for the Bund, and let me just tidy this up. And again, let me just move some lines here. This, and I'm going to make this chart a touch bigger. And let me just zoom back. I want to get this rally we had. Let's say, well, let's just call it the ECB quantitative easing fueled rally. Also, the dive into deflation in the Eurozone fueled rally here that we had, that really got going. Let's say June 2015 we had a very sharp correction lower, and it turned, and from June 2015 right the way through until August 2016 this thing did pretty much nothing but go up. And we had a violent correction lower March 2016, but it was temporary and we drove higher. And if I draw a line here at the top, 168.86 is the all-time ever high. This market reached its highest ever price and therefore lowest ever yield, pretty much 0% yield, or 007 was the yield point. And since then we've been sideways to very, very marginally lower, you might say, but certainly the last 12 months it's been in a nice range, and the range is really defined by 166.40. That's the top here in February. That's the high of the year. And then you got the low of the year with a bit of a bottom in November just above that. So the low of the year is down at 158.73. Okay, this is the range defined by this big sell-off we had back in February and the start of March. When you put it on this chart, it kind of puts it in perspective. So obviously if you're reading the financial press this week, then certainly the bond market story is the big theme, and they are right. The size of this sell-off is pretty huge. Actually, I'm just looking at this chart now. I'm not sure whether this is the... One sec. Is this up to date? Okay, maybe it is. All right, anyway. So from a yield point of view, I'm just looking at this from a price point of view, which doesn't stack up. But from a yield point of view, the Bund yield broke 0.5% yesterday. This is a very important key price point from a yield perspective. Remember, we have an inverse relationship between price and yield. So as price drops, yield goes up. And we broke 0.5% yesterday afternoon. Oh, sorry, yesterday morning. And this triggered a big kind of sell-off, which I showed you here. So around 10 a.m. we broke 0.5% and this accelerated the move down. From a yield point of view, this is the lowest yield, the highest yield we've seen for 18 months now. Okay, so this bond market story has really, it began when Draghi started speaking on Tuesday last week, 26th of June. We said it last week that last week could potentially be the most important pivotal week of 2017, of the whole year. Draghi started speaking. He started using words like reflationary. Some of the speech, it was quite a balanced speech, but some of the rhetoric on the hawkish side was a step up from what we were used to hearing from Draghi. And so everyone's like speculating, especially as Mark Carney came in with similarly hawkish comments. Everyone started speculating, probably over speculation, but anyway, everyone started speculating that, you know, was this a coordinated effort from these two central banks to really start turning the ship, the dovish ship around, and for these ECB, for the ECB and the Bank of England to really start to kind of follow the Federal Reserve in a more hawkish direction. You know, whilst we've got growth, certainly in Europe, and I'll show you some of the data we've had this morning, which continues to support the idea that the European economic situation remains strong. We had industrial production numbers from France and Germany. I'll show you those in a minute. But you know, whilst growth is strong, you know, isn't this the chance for the central bankers to at least end the unprecedented era of stimulative policy? I mean, at least end it, at least stop stimulating. Never mind, obviously, you know, begin to tighten policy. Obviously, the Fed are already doing that. But this bond market story has been the big one. Now, the thing about these bond market moves, it's actually, if you look at other asset classes, whenever you get the big bond market sell-off, and this has been a pattern of the last 2 weeks, whenever bonds sell off sharply, what happens? Well, actually, equities sell off sharply. Let me show you the DAX chart here from yesterday. What happened around about 10 a.m. when the Bund got going, you know, when the momentum built on the downside for price, well, then the DAX got going as well, and the DAX broke the low from the day before and accelerated lower, and in the end we just fell short of testing the low point set back end of last week, and consolidation since then. But when the bond markets really build up momentum, every other asset class takes note and follows suit. So bear that in mind, okay? Keep your eye on the Bund, for example. This is a key market and is driving the global asset space at the moment. So equities lower when bonds sell off. What about gold? Well, gold moves lower as well, actually. It's a bit more messy here for gold, I will admit. I'm just going to go to a 1 hour chart. Gold actually had its sell-off. Well, actually, sorry, it's a bit flatter, wasn't it? Gold actually didn't join in yesterday. It did the week before. Let me just see, around about 10 a.m. Yeah, okay, fine. Not too much action on gold, but we sold off almost like a delayed reaction last night. But I'll talk about this move last night because it perhaps wasn't anything to do with central banks. It perhaps wasn't anything to do with monetary policy. I think this move last night on gold to the downside was due to a trader's very large fat finger. And it actually wasn't on gold. Let me just drag in the silver futures chart. Check this out. This is a 1 minute chart. I've just gone back in time to last night, and here we were ticking along, you know, just minding our own business. Around about midnight, we get past midnight, and then at 6 minutes past midnight, bang, huge move lower. We went from well, in that 1 minute we went from $16.06 down to $15.54. This is a monster move here, and then as you can see, we pretty much almost fully retraced it just a few minutes later, and we kind of been in this consolidation ever since. But that's on a 1 minute chart, right? If I show you on a longer time frame, then this is what's been going on with the price of gold, and perhaps explains better why we've got this kind of downside. Gold had a big blowout day earlier in the week, big move lower. We made a new low, or breaking below the June low. Then we broke the May low. And what actually happened last night, if we go to a weekly chart, what actually happened last night was we briefly, and it was briefly, we're back above it now, we briefly broke the December 2016 low, and actually therefore made the lowest price point since April 2016. So some of this is technical. It's being blamed on a fat finger. I mean, I don't know whether that's necessarily true. You might have just got an aggressive breakout trader with some punchy size pushing this price through technical levels, triggering algorithm stop losses, which then generates the sell side volume that can actually result in a very large movement in a very short space of time. So this could have been like a flash crash scenario rather than a mistake. You know, fat finger is a trade where somebody, you know, trades by mistake, or they trade a size that's let's say a factor of 10 bigger than they were intending. They put an extra 0 on the order size by mistake, or you know, something like that. But anyway, this big move lower in silver yesterday, obviously gold's correlated. If you go to a short time frame for gold, then the move lower on gold last night was at precisely the same moment, okay? Just after midnight, silver broke lower, dragging gold with it, and we've kind of been sideways since then. So that is a bit of a story getting some attention in the news last night, but I don't think that's anything, let's say, macro related. It's more kind of technical, I would say. So, yeah, bond markets, this is something to keep your eye on for sure. They are driving things, and at the moment, equities, when bonds really start moving, equities go down with them, okay? So just bear in mind a break in perhaps the more traditional correlation. The other thing that's happened, obviously, since the Draghi comments last week and the Mark Carney comments is, of course, we've had some pretty substantial movement on the FX space. And you guys know this, you're looking at these charts, but just as a reminder, you know, euro dollar up here on 12-month highs. We just fell short of the 115 handle here end of last week, and for now we've been drifting lower, although we're back up. I mean, I would say we are just one bad non-farm payrolls number away from smashing the 115 handle, and this, you can see this very pronounced upward trend in recent months continuing. What I would say, just on the monetary policy side, and given that Draghi kick-started all this volatility and all this movement, what I would say, if I go to a weekly chart, do bear in mind, if this thing goes too much higher, that's the euro dollar, if it does break 115, let me just tidy up this chart. If we do break 115, the ECB are going to start to get a little bit uncomfortable. Okay, we've only been really above the 115 handle on 2 occasions since really 2014, and that was very briefly August 2015, and again very briefly May 2016. 115 is the upper limit, I would say, for the ECB's for the ECB to remain comfortable. If we get above 115, I wouldn't be surprised if you start getting some slightly less hawkish or even some more dovish comments from the ECB trying to talk the euro back down. So just bear in mind, the ECB are praying for a strong payrolls number today so that you get some dollar strength to drag this thing back lower. So do bear in mind, if these exchange rates go much further, or if the euro dollar goes much further, perhaps anticipate some dovishness from the ECB. Not the case for the pound, though. If you go to a weekly chart here on the pound, obviously the pound is still incredibly cheap for Brexit reasons, and what we did this week, or last week I should say, was tested the key top. It's the 2017 high, 130. Well, I guess we did break it briefly, 130.61, but we tested it. We got a key double top here, and again, we're one bad non-farm payrolls number away from breaking and making new highs for the year. But obviously the pound's still very cheap, so it's not like the Bank of England. They'll be pleased about sterling continuing to march higher, because that'll help to dampen some of this inflation pressure that we've got. So currency's definitely on the move, and really it was all about Draghi who kick-started this episode of volatility. Right, just a couple of other things then to mark off. here was just a chart of the yield side of things. So rather than looking at the price of the bund, here we've got the yield movement. This was yesterday. We had a French bond auction. Some of the press are talking about the French bond auction perhaps being responsible for this extension lower in bond prices yesterday. I think it helped. I don't think it was necessarily the main catalyst, but we had a French 30-year bond auction where the bid to cover, or let's just simplify and call it the demand for these bonds, was a lot lower than was expected. And this led to a bit of a sell-off. Maybe that's what triggered a bit of a move in the bund, but I think it was the break of the 0.5 yield handle that kind of did the damage. ECB minutes later in the day, which also, I guess came in, I don't know, there wasn't too much new in it, but it came in perhaps modestly more hawkish than perhaps expected. And so this is this yield front, the break above the 0.5 handle's key. Okay, highest yields for 18 months. What else has been going on? So this morning, we've had a couple of data points from Europe on the industrial production front. German industrial production came in. This was released at 7 a.m. Better than expected. So for the month of May, so it is old, but for the month of May, industrial production rose 1.2% compared to the month of April. So we were expecting an increase of just 0.3%. So nice solid number from Germany. Here's the chart. I mean, I would say on this chart, it's not like it's the biggest monthly growth ever, because it's not. We actually had a higher monthly growth rate just 3 months ago. But I think the point about this chart is look at this cluster of positive prints now. Normally industrial production is pretty choppy. It's quite volatile month to month. You get some big swings, positive and negative, as you can see. But this is 5 positives in a row, with a couple of them actually, or 3 of them actually pretty decent, above 1%. So 5 positives in a row, 3 above 1%. That's the best run.
Next up in 10 minutes time.
Just looking back on this chart, which goes back to 2011, this is the first time we've had 5 months positive in a row in this time period. So that it's the consistent growth. This is, a key signal that this European economic revival, which is leading to Draghi being hawkish, this European economic revival is really still there, although I would say this is for the month of May, remember. So, it is old news. The French number on the same measurement, industrial production, also better than expected. So that got announced at 7:45 a.m. Industrial production up 1.9%. We had expected 0.5, so nice punchy print higher here. But for France, it's definitely less consistent. We've still got this choppiness, this seesaw swing from positive to negative, but you would say the positives have been larger than the negatives, so at least a positive pathway here from France also. This is that silver move. I've already showed you that on the chart, but this is just looking off the Bloomberg screen. So the big spike, and actually this one was bigger. On my chart on the futures, the low was 15.6. So here I think we've got the spot. I know this is silver futures as well. It must be on a different exchange. But anyway, this dropped to 14.3. So actually even a bigger move on this exchange. So fat finger, technical, algo, flash crash, call it what you want. But you can always tell it's some kind of non-macro related issue when the enormous move almost immediately gets fully retraced. In other news, what have I done? I've done 20 minutes now of this briefing, and I haven't mentioned UK politics once, and I'm kind of a little bit aggrieved to mention it now. But anyway, there was a YouGov poll last night, and the Labour lead has increased. If so, this is just saying, if there was to be a general election, then Labour looks like they would win it, which is why there won't be a general election. By the way, what I mean by that is, all right, Theresa May's leadership is teetering on the brink, but obviously at the end of the day, if the Conservatives, if their in-party division leads to some kind of failed vote in the Commons, or some kind of leadership challenge, or some kind of loss of confidence that triggers a general election, well, they're going to lose. So obviously they're not going to want to lose, so they will make sure all right, they go as far as possible perhaps to indicate their displeasure with the current leadership, but they're not stupid. They don't want to lose their job. You know, politics always comes down in the end, this is a bit cynical, but politics always comes down to self-preservation. These Conservative MPs don't want to lose their job. If they create a general election through not voting through a May policy, then they will be potentially shooting themselves in the foot. So I would say the more the Labour lead gets in these polls, I would say ironically, the less chance Corbyn has of being Prime Minister. That would be my view. Let's look at the data calendar. So we got more stuff out of Europe. So we've got, you know, insignificant stuff. That means markets won't have an impact. Markets were trading. Stuff like Italian retail sales, that's due in 7 minutes. More interestingly, at 9:30 we'll get manufacturing production from the UK. As well as industrial production numbers, so and construction output. So quite a bit of data at 9:30 from the UK. But certainly the main kind of event is this afternoon, where we're going to see the key non-farm payrolls figure. So this is the job creation data in the US for the month of June. I'd say also never forget the average hourly earnings figure, which is key, really important from the Fed's point of view when they're trying to gauge future inflation pressures. So we're expecting 0.3% on that side. Less important, the unemployment rate itself is expected to remain at a like decade low of 4.3%. Okay, so just to have a look at some charts, we've had some data on employment already this week, of course, and on Wednesday, for what it's worth, the ADP number, this is the private sector payroll data, showed a worse than expected reading at 158,000. Also quite a sharp revision to the month before, a 30,000 negative revision to the May print. That data there tells you that job creation was weak or weaker than expected. However, definitely bear in mind the ADP measure has been a rubbish indicator for non-farm payrolls in the last few months. Just because ADP was worse than expected on Wednesday, by no means means that non-farm payrolls is going to be worse than expected today. All right, the correlation's been actually notably bad between these two readings. So I think traders are, yeah, okay, fine, this is worse than expected, but I think they're not. This isn't. I don't think the ADP print is going to be in anybody's mind just as we're waiting for the payrolls number. Perhaps more interestingly, the ISM data, that's the manufacturing and the non-manufacturing, the services data that we've had from the US this week, both figures had solid employment readings. The ISM non-manufacturing employment component did drop from the month before, dropped back to 55, but 55 in itself is still strong. The manufacturing print increased and improved. So there have been employment-related data announced this week that have been strong. With regards to payrolls itself, this is the chart that we've got looking back over the last 12 months, and it's just been really bad. I mean, let's not beat around the bush here. The last 3 months have been bad. If you take the 3-month average, this is something traders look at. I mean, these numbers month to month can be quite volatile, but the 3-month average normally irons out that volatility, and you can see 50, all right, 174 is decent, but 138 is weak. You know, anything below 150, obviously anything below 100 is notably bad. We're expecting, I think the latest forecast is 179 today, but two things to say. Firstly, yeah, we've had a bad run on payrolls, but don't think that's necessarily just bad news, because ultimately the unemployment rate's at 4.3%. So, you know, you could argue in some measures the US is reaching full employment, which means there's less people looking for jobs, looking to gain jobs. I know there's a whole issue with the labour force participation rate, but I won't go into that now. But it's notable that we've had the worst 3 months for non-farm payrolls for years, and yet during those 3 months, basically the Fed hiked rates twice and started talking about tapering their reinvestment program. that tells you that the Fed actually don't really care too much about non-farm payrolls anymore. I mean, they certainly used to, for sure, but now the unemployment rate's so low, job creation's less important. So do bear that in mind. What I mean is, markets are perhaps less sensitive to big non-farm payroll prints these days, and maybe we should be looking more at the wage growth side to think about, you know, medium-term core inflation trends. Maybe the final point just to say, though, because we've had 3 bad numbers in a row, I would say if we get a good number today, and what I mean by good would certainly need to be above 200, ideally, to make it really interesting, above 232,000, which would make a new high for the year, and indeed a new high since, you know, back in kind of summer of last year. If you get that happen, that'll just feed into the kind of hawkish story that has led and driven market movement for the last 2 weeks. The hawkish kind of pattern of market behavior triggered by Mark Carney and triggered by Mario Draghi. If you get a punchy payrolls number today, that'll really feed into that story, and you may well, perhaps that'll be the event where we're going to see the most price action off. Okay. All right. That is it for the briefing. What we'll be doing is a full non-farm payrolls preview, which will be beginning around about 12:10. So we're going to do it pre-lunch. We'll do a non-farm payrolls preview, and then obviously the event itself, the date's at 1:30. Okay, so that's it for the briefing for now, guys. Good luck. Enjoy the session. Thanks very much.